Let's see what, um, yeah, yeah, I have it here actually. I have it open on my YouTube app. Oh my God. That's all good. No need to, um, we'll cover we'll cover that topic again in the future. Um, and so, uh, maybe we can do a TLDR. Damn, you missed the whole explanation of this back test. Oh my gosh, that's so funny. Do you know what was I talking about when the live stream cut off? Okay. Uh, okay. So we're back. Sorry for the technical difficulties. Some internet went out. We'll have to look into the arbitration clauses in those internet provider contracts, see if we can, get them to upgrade your service at no cost to you. Yeah, and it's got to be, from their perspective, it's got to be tough to deliver internet out there. Like that's still a tough logistics problem, but you'd think that like where's our satellite internet down to us? Like, come on. um, all right, so we're back again. So we don't know really where that cut off, but kind of the long story short was that there's no way to tell when the bottom is. So the best strategy is to be saving up your money all the time, like always be building up your savings from your other forms of income. So when you're making dollars from your job or from other investments, you want to be safe. You don't want to be buying. You don't want to be FOMO buying in. Like you don't want to be buying the top. Like when price is going up and everyone's talking about it, you don't really want to be buying the top. You want to be averaging in when price is going down, because just about every couple months, price just goes down. Like you'll have like a couple of days or a couple of weeks where you can just be averaging in, and by doing that, you can approach these levels, like just like make it so that like the average price that you ever bought is always just below like the average price that people are paying on a regular basis. So like what you want to be, you want your average line to be lower than these averages. So like when we look at like these moving averages, you want your average buy order to be way lower than the average of everybody's buy order. Like you want to be the 1%. You want to gain the power. You want to gain the wealth. And just having more money than others is a way to do it. And so buying at the lowest price, that's how you can get more. And so that's really what the whole strategy around catching dips is. It's really more of like a lifestyle. Like you always want to be saving and accumulating more, because the stronger your crypto collateral base is, the stronger that the better equipped that you'll be to seize opportunities when you see them. Like when you see like an altcoin that you think could go up 100x, you can borrow against some of your crypto and then make that trade. If it goes your way, you made a ton of money and you took very little risk. If it doesn't go your way, you can spread that loss over a longer period of time, and it wasn't all of your money that you had to start with. So that's like a way to just like be able to take that risk and use the volatility to your advantage, like catch these dips, because you want to be able to seize opportunities when they approach. And so if you go to dipcatcher.com, you can sign up for this email alert system. This is what it runs on. We built in TradingView. And if you want to see how to build TradingView algorithms, we have a video. I don't know if we've published it on the YouTube channel. Maybe we'll have to, but we've actually built some of these on our live calls in the past. And so, so sign up for the dip catcher email alerts at dipcatcher.com, and this is what it'll help you do. It'll help you, get your average buy order just lower than the herd. Like, it'll help you be in the 1%, so, so that's all we have on this, first topic. Sorry for the interrupted live stream on this. We'll have to, this, we always talk about this. There's nothing new I said here. Like, really. Yeah. Yeah. Like, this is, we're always looking for this. And sometimes that's funny, since we started our calls. So, and since the first time the dip catcher algorithm went live was right before this wave of green right here. So that was like when first dip catcher launched. And then like when we started our calls was like, I think in March or April, literally for like the whole duration of this time, there have only been like 5 days that the email alerts have gone out. And so it's like so anticlimactic because price has just been going up. So like, it doesn't, like, there are no dipstick. Yeah. And then pretty recently, so like I turned on the 4-hour ones. The 4-hour ones happen all the time, but these are a lot riskier because like, it's just like on a shorter time frame. And so like, this is pretty much like, it's always telling you to buy. This is one that you can like take short-term trades on. It's still not very optimized. Like, this is a pretty tough one. I mean, like, if you were using this going back to like all of 2019, your average price would still be way below market price right now. So it's still a good strategy, but this has you buying a lot more. Like this, like, look right here. Like, you're buying all these dips, even when like price is pretty high here, like before like a massive sell-off, like it still has you buying high. So this is like one that if you're actively trading, you can sign up for, like, if we go to dipcatcher.com. If you're an active trader, maybe this 4-hour one could help you out, at least help you as a filter. Like if you take the high risk one, active trader up to 6 alerts a day. If you take if you do that one runs on this 4-hour chart. And so, if we just zoom in, let's just pick like a random one. And shout out Ty. Ty was the one that prompted me to back test this one, because this has always kind of been my like gut feeling one about like just how to think about like averaging into low prices. But Ty actually prompted me to back test it, and that's like where this white line comes from. Is from like a back testing algorithm where it just like looks back in time and measures the performance. So shout out to Ty. He's a frequent listener and occasional guest, for kind of prompting me to think about it, in that sense. But when we zoom in on this 4-hour one, so this is like the high risk one. You click that on dip catcher. Like just from like a quick spot check, like if you're buying here on these buy signals, like in the following hours and days, you have chances to sell at higher. So sometimes it catches a dip that keeps dipping, but like on pretty short time frames, like sometimes it gives you pretty good trade opportunities. So always like you're always at your own risk in using this. Like, we haven't set up one that actually trades for you, and even still, like, it's always your risk. Like, you should never blindly trust an algorithm. But you can at least use math and use statistics to help you focus in on days that are good to buy. And this, I think, even for like short-term trading, it still can be like a good filter for what trades to take. This in combination with other things. So if you're like actively trading, you can sign up for the 4-hour chart algorithm. The mid risk is probably this is probably the one for generally everybody, like as a saving strategy. And that one runs on the daily chart. So this daily chart, it can go months at a time without a buy signal. But what this helps you do is, like this is just like, for like a longer term strat, like if you don't want to be like, paying attention every day to know when to buy, this is a good one. Like you don't have to be as accurate in this one. On the 4-hour chart, you have to be more accurate in your timing. In this one, doesn't really matter. Like, price can go up and down during the day. It doesn't really matter when you're buying because you're buying with like, months to year time horizon on this. So like this really like doesn't, this is better for just like the average person who's not putting a lot of time into this. And this one helps you average into these like longer term downtrends. So like even if we were to like start, so this one started at this bottom. Let's even pull this back into the. We're going to go back to December of 2017. So if you got swept up into the hype of, you bought the top, like, I guess it wouldn't have started. Like, so even like the dip catcher algorithm, it would have helped you avoid buying the 20K top. Like, everyone got stuck. A lot of people, like literally a lot of people that I know, they're like, what the heck, man? I bought it 20K. Like now it's at 6K. Should I sell? Like, I'm like, like just keep buying. Like it's the best you can do. And like, so if they would have done that and just like made, the crypto, like the Bitcoin savings as part of their strategy and just bought these dips, the dip catcher email alerts, had they been around then, like been telling them to buy, they would have brought their average price down to something like, $6,300. Like, that's pretty good. Like, over this whole year. Yeah, well, so they wouldn't have bought the top. So, like, yeah, like, so their first buy order would have been $10,000. So, like, because, like, in 2017, the prices are going up so fast that this algorithm would have helped them avoid it. So like, had they, first, like say someone bought, $1,000 at like $1,000 of Bitcoin at the 20K top. And then over the course of this year or over the course of these, 2 years, had they just like spread that like another $1,000 over this period of time. So really not even buying a lot, just averaging in over this whole 2-year period, every paycheck, put a little more in. But on the days that the email alerts are going out, your average price would be down here in this like $6,400 range. So like if you had $1,000 spread out, $1,000 at 64 and your $1,000 at 20K, now your average price is what, 6,000 plus, 6,000 plus, 7, so like 13,000. Your average price is right here around 13,000. You could have sold all your crypto a couple of weeks ago and almost broke even. Like literally, like it can help you recover from making bad trades. Like, if you bought the top, don't sell the bottom. Like what you could have done if you bought this $20,000, if you bought $1,000 of crypto at this $20,000 top, and then price goes down, say to this like $3,000 one. So your $1,000 is worth, let's measure this. If your $1,000 is now worth $150, what you could have done is taken this over to Kraken without even putting new money in. You can take this over to Kraken, go 5x long, and you could have bought bought crypto at 3,000. So 5 times 150 is like $750, right? And you could have, had $750 of Bitcoin that, went up. Like, so if you would have kind of like used Kraken as like a revolving, like that 5x leverage, it cuts off it every month. But if you kind of treat it like a revolving credit line, if you just like, took a lot of risk and like risked it all to like go long in this move up, like every 20% up, the initial amount that you have doubles. So if you 5x like $150, so times 5, so $750 is what your like margin position is, even without putting new money in. This is money that Kraken lends you. If you were 5x long during this whole time, every single 20% move is up another, that is up, you're up, you double your $150. So 20%. So there was, 5 times 3 plus another 2. So about 17, so going 5x margin long from this bottom, had you timed it well, you would have to do that. Like you would at least have a chance to more than break even from how much you lost going down, because you only lost 85%. But by using leverage during this dip down here, you can lower your average buy-in order, because when you borrow against Bitcoin you already have, you don't need to put new money down. You're just risking Bitcoin you already have. And then if price, if you go 5x long, every 20% you're doubling whatever you had at the start. So if 17 times 17 times 150, 17 times 150, your $1,000 that you put in at the 20K top would have now be worth 2,500. So that what that means is that your average buy order price would be, somewhere down here. So it's just a way that you can make up for buying dips with leverage, using strategies like this. It just helps you, make up for bad trades or spread out your losses over longer periods of time. And so that's really the power of this. So, signing up for the daily one is a good way to make up for bad trades. And it's just a good saving strategy. It's one where, you should be saving money all the time. And so, just putting money into crypto as savings when price is low, even if you bought some and the price goes down more, that, you view it as a good thing, because this is long-term savings money, and it gives you a good opportunity to buy in at potentially what the bottom was. You don't know where the bottom will be, but you just want to be buying at potential bottoms. And then, then when the bottom happens, then the amount that you make on the very low orders, it helps to compound how much you make overall from the higher orders. And so the daily one is that you can sign up for here with mid risk. That's good for general strategy. And then there's the low risk, where this is on the weekly chart, and this thing barely goes off. It would have averaged you in down, from $470 to $220 back in 2015. Would have averaged you in from $5,000 down through $3,200 in 2018 or 2019, and then averaged you in the $4,000 to $7,000 range a couple months ago. But this one rarely goes off. So this is a much lower risk one. And so when price is down here, it's if you want to sell the farm to go in on Bitcoin at the end, that's probably when you want to do it. A lot of people sell the farm to go all in on Bitcoin when the price is high, and they're the ones that get wrecked. But if price is very low, and people are giving up on Bitcoin, and people are just done with it, that's good times to buy. And so that's what this low risk one tells you. But those are very rare. Since I've turned it on, it gave those out, but I don't think anyone was even signed up at this time. So I was the only one that was getting those. So you can sign up for those here at dipcatcher.com. And that's really, what the whole, so when price goes down, what we've been seeing, that's when you want to start paying attention, because that's when the good opportunities to average in are. So that's all on that topic. So we're going to kind of switch gears to some more of the things that we've been talking about over the last couple of weeks, which has been a lot of the craziness that's going on in the Ethereum ecosystem. Bitcoin's kind of your savings money. It's the gold. So the thing you want to buy and hold on to for a long period of time, hunker down on it. But for more exotic financial instruments, all the innovation is going on in the Ethereum ecosystem. And so Hex really kind of kicked off this whole DeFi wave. It was Uniswap is the exchange that we use. That's really been powering you know, a lot of the, you know, a lot of the, like, you know, this like new wave of innovation in the Ethereum ecosystem has been this, you know, trustless swapping system. And Hex was like the first major use case of that. Like when we go to like the person who, like, the most popular like site for viewing like like some of these Uniswap tokens is uniswap.vision. Uniswap was built by someone in the Hex. Uniswap.vision was built by someone in the Hex community, because when Hex first came out, there was no good way to look at the there's no good way to look at the chart, because you know, way back here, there, like when it launched, there's no way to look at it. And so someone in the Hex community built this, and this is actually one of the most popular, you know, one of the most popular tools in the whole ecosystem is something built by Hex community members. Yeah, and so like, you know, Hex actually has a major part to play in some this whole, like, you know, all this hysteria we've been seeing, like you know, these things that we, you know, because, well, you know, yield farming is like, you know, this new wave of like excitement in the crypto ecosystem, and what it signals is it signals demand for yield on investments. Like people want to, you know, like what you used to get from a savings account, where you put money in your savings account at the bank, and you might get like 6% or 4%, whatever the interest rate was. I don't remember, like, you know, it's nothing. I don't even think about it, like, because it's effectively zero. Some places it might be negative, but like, you know, people want to earn yield on just like static cash, and so yield farming is like, you know, like by having a financial ecosystem that operates as part of smart contracts. Any type of contract you might have entered in the real world, like through the traditional banking system, you can now enter in on Ethereum, like through a smart contract on a blockchain that, in some cases, there are some people that kind of have their hands in it, but in some cases, there's no counterparties, like there's no admin keys, you know, where you might lock your money up and then earn yield. So there's like been this whole wave of like hysteria, like literally true craziness. Like, so we get a yield farming, like true craziness in the Ethereum ecosystem around, you know, yield farming. Like a lot of this was kind of kicked off by Hex. I mean, you know, they obviously weren't the first ones to like do this, but like the first like major wave of this really came through Hex. You know, like this whole concept of staking money and then earning on it. Like that's what you're doing in Hex. Hex is a little bit different than some of these other yield farms. Like I think Hex, like I view Hex as the risk-free yield farm, because you're not, you know, lending and like it's not based on lending and borrowing. You know, you get paid from inflation, and you get paid that inflation because you're providing price support. When your coins are locked, they can't push the price down. And so you can at least like guarantee that like those coins will, so it gives information to the market, and the market pays you for that. And so like, you know, Hex, you know, we had our first major move up, you know, so from like, you know, if you bought even not at the very bottom, you know, Hex, you know, and it's like for, you know, early period of time. So we're still about almost 1,000% up. You know, it got as high as 5,000 measured in ETH. So let's take a look at the Hex USDC. That's a little bit better. This is just because ETH has gone up so much during this time. So, you know, buying, you know, down from here. So this one up still 4,000%, you know, from there, as high as almost 10,000%, measured in dollars, way outperforming dollars, you know, majorly outperforming ETH, even through a massive sell-off. But like, you know, Hex really kind of kicked off this first wave of like, you know, yield farming assets. And it's so funny, like we've been yield farming since before yield farming existed. Like, how do we find the like oldest tweet finder? Let's see that. How to search old. So Let's find this. How do we find, okay, of course. How do we do Twitter advanced search? Let's say, Daniel, what do you think the oldest yield farming tweet is going to be? February? Okay. Okay, so here, we're just going to do Google Trends. We're going to look at a couple common terms like that you might hear when thinking about yield farming. So there's staking, which Hex is all about staking. So staking has been around for longer. You can like Nexo, you would, like when you use Nexo, you can like stake it and like earn extra benefits when you're borrowing against it. So like staking, let's see, staking crypto. Maybe that'll be a good filter. All time. Sometimes like the coin themselves is just an ERC20 coin. So like the coin itself is complete. So there's not like any like coin development going on, but there's like ecosystem development going on that's like critical to the success of the coin price. So in some ways, yes, but as far as I know, not really. Like Hex is very unique in that sense, where it's like, it's like truly complete. Where you like, yeah, there's community and like ecosystem development, but it's really around marketing. Like the go.hex.com like staking site will work forever. Like if everyone that ever thought of Hex, like right now, if like there was something crazy happened and like everyone in Hex like just suddenly disappeared, like Hex would still continue. Like if all the sites went down, like you could still like interact with the Ethereum blockchain and do the Hex smart contract directly. So like Hex is done, like there's nothing left. So all that's left is like marketing, really. Like, and then like as some of the Hex like network effects start to build out, maybe there's like other developments like Hex lending or Hex borrowing and like all kinds of stuff. Or like in a lot of the development, like that stuff can happen outside of it. Like Hex could be something that could be used by some of these yield farming platforms, which we'll talk about here in a little bit. Like, so like Hex is pretty unique where like the coin itself and the monetary policy is done. And a lot of the other stuff is outsourced. So, like the blockchain, it's outsourced to Ethereum. So like, nothing that I can really think of. But like staking crypto has kind of been around since like, January of 2018. Like there were cryptocurrencies that were like, proof of stake or like, ones that were based around staking. Like it used to be called like running a master node. Like, so if we look up like master node crypto, we'll see, that was going on in 2017. So let's cut that off to be custom past, let's go past 5 years. That'll give us a good, so early, like, 2017 masternode, that's like effectively staking. That's where you have to have a certain amount of coins locked in your own node, and then you get to earn some of the inflation. So that was like an old type of staking. And like even like Bitcoin mining, that's like a form of staking, right? But like it's different because you're not. It's like you have stake in. It's like you have stake not in the coin, but in hardware and power that like runs the security software of the coin. And so it's like you're staking a different form of capital. Like you're putting, like in Hex, it's like you buy Hex up front. So you bear the cost of buying the Hex. And then over that period of time, you bear the opportunity cost of having it staked. And you're getting paid for that in the form of the inflation that you earn. Whereas like in Bitcoin mining or any other crypto mining, like you bear the upfront cost in the form of, there's two costs there. There's the actual hardware cost, and there's the opportunity cost of having just bought the Bitcoin. You know, a lot of the times, like crypto miners are better off just buying the coin. You know, they would have just had more Bitcoin. So like, you know, it's a pretty big cost, but it's not holding the price of Bitcoin up. If anything, it's pushing the price down, because like they're otherwise, like with that money that they're spending on the miners, they're not just buying the Bitcoin. So in many, like Bitcoin mining, you can't really think of as staking, but it's still a form of like, you put up some type of cost and you're earning crypto from it. You're earning yield. And so like even Bitcoin mining, you know, Bitcoin mining maybe was the OG yield farm, you know, like, you know, maybe that's it. Maybe we have to define, like, maybe Hex didn't invent yield farming. You know, there were kind of different forms of it, you know, where like in Bitcoin mining, you had to, you know, buy the miners and then pay for the power to run them. And then that's how you earn Bitcoin, you know. But if we, you know, ignore that, let's, you know, then there were like master nodes. And that was like a very obscure thing. Like barely anyone, like we look on Twitter for master node. What do we see here? You know, like people still do that. Like there's master nodes, like, you know, there's these random coins, like these are master nodes. Like I've never heard of any of these. So they still exist, still a thing, but staking crypto, like, you know, but staking is like a newer concept. And then, but if we compare that to yield farm, I guess that is a new, that's pretty funny. So that must mean yield farming must have been used in a different context. Let's see if we can find, oh, I know why. Yield farming is, I think that's an older, like that must be a search term for like farm yield, like real, like growing potatoes, like yield farming potatoes. Great, yeah. So this maybe isn't a good reference, because people who have been talking about farming yield forever. Like, okay, so this isn't a, but right now, like how much? Yeah, but here, actually, this is a good reference, because like farming yield. So let's ignore that. It's just like, so because taking crypto. So like, it's such like a, so let's only segment that from 2004. How do we go back? Whatever, we don't need to do that. So like, if we only look at like this period of time, like, you know, it's kind of a constant thing. It's always being talked about. But like, there's been so much buzz lately. There's more Google search traffic for people learning how to earn yield on their crypto than people trying to earn yield on their physical land. Like, you know, yield farming crypto. Let's see. I mean, even then, there still is more people right now talking about, I mean, that you know, talking about, I guess now it's broken through. Yield farming crypto is broken up higher than just regular yield farming, which, you know, at like during times before yield farming and crypto existed. So like, if like, you know, the average benchmark, say, is like 4 right here, you know, just recently yield farming on the internet just surpassed yield farming on real farms on Google. So like, it's a big thing, and it's really earning interest on your coins. And so, you know, there was staking, and then now yield farming is the thing. And like, you know, Hex, I think, is the yield, is the, like, compared to other types of yield farms, I'd say Hex is the risk-free yield farm. And that's because like in these other ones, it's like absurd risk you have to take. Like we talked about it in Yams, like Yamcoin, like, you know, if we go to yam.finance, which, you know, go back and watch that was such a fun episode. Look at this. This is the risk of yield farming. Like, it's so funny. All the crypto, like the mainstream crypto people, you know, they think they're the counterculture, but they're the mainstream. They literally hate Hex. Yeah, they're the mainstream. They're like the gatekeepers. Like they loved YAM when it came out. They're like, ooh, buy YAM, buy YAM. Same people that call Bitcoin or same people that call X a scam. They're saying go out and buy some YAM. And there are people that literally lost the YAM farm on the YAM. And so it's so funny. Literally, you read the like these are the risks. Like so, Hex is like a risk-free yield farm because it doesn't require any type of like borrowing and lending. Like there's no concept of that. When you lock up your coins to earn yield on these other ones, what you're actually doing is you're giving it to someone else to like lend to someone else and earned interest that they're lending it to. So there's pretty much two different types of yield farms. Like so we've kind of talked about YAM. That's like the YAM V1 farm. So let's take a look at this. So I do not recommend using YAM. Like it is risky. Like if you're looking for like, to earn yield, oh God, what's my password on this one? This is like a demo account. Okay, I do not. So we can't take a look at these. Let's, maybe we can, how do we set up a new, okay, I'm not gonna pull out my other browser here. So we'll just, we're not gonna look at these yield farms, but like if we just look at Twitter, like when you're like, there are two different types of yield farms. One is where you're actually like putting money into you're actually like lending your money. So one of that would be this platform called AAVE, which Daniel had asked about, because it's kind of like Nexo. AAVE is like yeah, it's pretty cool. I've put in some collateral into AAVE, but I haven't borrowed against it yet. Now that the prices are low, I think now's the time. But I didn't risk very much because I'm not like, I'm still kind of like, I haven't done a full deep dive on this to like really understand what the risks are. But with just a little bit, like, that's the only way to really have context. So how do we go back to the, so we're on the app site. How do I learn about it? So so pretty much like the two different types are where you can put money in either like a lending pool where people are borrowing like from it, or you can put like, so that's one type of yield farm, and a really common one is like by doing it with stable coins. So like, because these are the things that people are borrowing, like on Nexo, like, you just experienced it there. When you borrow on Nexo, you're borrowing a stable coin. So it's like a thing that many people are borrowing. So like they'll pay you interest for it. And so that's like one type of yield farming, is like where you're going, there are all these different types of like, if we just look up like, yield farm platforms. So yield farm lend. So like you can be, like lending it out through these pools. So that's one way to earn yield. Another way to earn yield is to be providing liquidity in these like, to these like Uniswap pairs. And then people build in these incentives to where if you're providing liquidity, they will pay you in some other coin. And that's what YAM is. So like here, let's do this. Let's see if we can reset our MetaMask. Let's try to do this here. How do we do this? Okay, I'm gonna go ahead. So the other way to be doing is through these like liquidity, like where you provide liquidity through their platform. And so what you're effectively doing is you're earning trading fees. So the yield you're earning it originates from trading fees. And they like, so there's all different types of, we'll have to do a whole different topic on like the whole concept of liquidity providing to these Uniswap pairs. Okay, so this isn't gonna open for some reason. But so there's kind of two different ways to do it. And what you're really betting on is that there's still gonna be people borrowing and lending. And so you're making money purely on this like business use case of borrowing and lending on through whatever smart contract that you are staking your coins through. So like if you're doing like a yield farm through through one of these YAM yield farms, or no, so YAM is liquidity providing. So you're betting that people are going to continue to trade in high volumes whatever thing that you're providing liquidity for. And so that's that's like a risk you're taking. And you're also taking the risk of the exchange rate risk. So you're taking the risk that the coin that you're earning the interest in, like the coin you're earning the yield in, you're betting that the price is going to stay up. So if we look at the YAM2 price, so this is what you're earning by staking through their liquidity pools, meaning you're pretty much lending them your stake in the liquidity pool, and then they're lending that out and then paying you with yield from that. So that's what yield, it's a pretty it's a very advanced topic that people are doing, and but it relies on people continuing to so you bear the price risk, price of the thing that you're earning could go down, and people could stop trading the thing that you're providing liquidity for by being part of this yield farm. So there's kind of two risks involved there for that type of yield farm. And then for the yield farming that's you're just lending your money out, you're bearing the risk of the yield that you're earning, or the risk of the price of the thing that you're earning the interest on, and you're risking that there will be demand to borrow whatever asset that you have. Like if you have an asset that nobody wants to borrow, then you can't earn any yield from that. So there's kind of two elements of risk right there. And so for different types of yield farming, they're actually pretty high risk. And there's actually been a pretty recent innovation, this thing that it's called YETH Vault, which we can actually, there's a YouTube video that we should actually just watch right now. Let's see if we can. So let's see if we can find a YETH. It's called yearn.find. It's pretty much like an automated yield farming, because people got crazy with it. Let's see, yield farm. Let's see if we can find. Oh, YFI. So YFI is the governance coin. It's like a voting coin. Remember how we talked about governance coin can sometimes be a form of overhead? So YFI is the it's like the coin that kind of powers this whole ecosystem, but it's not really part of this of their automated yield farming. So here's it's called the vault, the YFI vaults. Vaults follow a unique strategy. They're designed to maximize the yield of the deposited asset and minimize the risk. So when people are yield farming, they're it's pretty much this whole, a simple way to think about it is that you're posting collateral in one place that you are then taking out a loan and then placing and then lending out the loan that you took, and the interest rate that you're earning on the money that you're lending is greater than the interest rate that you are paying to borrow. And so the difference in those two interest rates is your profit. That's your yield. That's your yield farm. So there's all these different ways that you can earn that yield because there's so many stable coins. If we look at a list of all the stable coins, like all these ones are ones that you could potentially be, be like earning yield by borrowing or by lending, because people who are trading cryptocurrencies, they're borrowing stable coins. Like, you're like on Nexo, you're borrowing a stable coin. So like, because it's a lot less risky to take out a loan paid in this. And so there's let's see if we can see a list. There's Tether, there's CRV, there's, USDC, there's Curve, there's like DAI, there's all these different ones that you can be earning yield on. And so that's like a pretty common way, is where like across all the different places that you can either be borrowing or lending, all the different places you can be borrowing or lending stable coins, you can arbitrage the interest rate on these different platforms, just based on the different market forces. There still is a lot of like, arbitrage to be made. But now with things like this like these vaults, this is pretty much where you can just put your money in a pool, and this vault has an automated strategy that finds the best yield. So with this, like the equivalent of these like yield farming vaults, it take like, let's see if we can find the video. So YFI, how do we learn? Let's see if there's a video. This is honestly something that like, what is YFI vault? Let's see if there's a really good, yeah. So if this is short.
Confused about how Y-Earn Finance works and what is the Wi-Fi token all about? You'll find out all of this and more in our DYDX.
Okay, here.
This month is all about. The main element of Y-Earn Finance is the Y-Earn or Yearn protocol. The Yearn protocol, in essence, is a yield optimizer that focuses on maximizing DeFi capabilities by automatically switching between different lending protocols. Before we explain the mechanism of the protocol itself, let's see how Yearn came into existence. In early 2020, the author of the Yearn protocol, Andrei Kronier, started looking into automating his strategy for choosing the highest paying lending protocol for his stablecoins. Before the first iteration of the protocol, Andrei had to wake up every day and manually check which protocol pays the best APY on that day and consider moving his funds to that protocol. There were always a few options available at the time, such as Compound, AAVE, Fulcrum, or DYDX. This manual work quickly became repetitive and boring, so Andrei started coding the first version of the Yearn protocol to automate the whole process of choosing the most optimal strategy for his stablecoins. The protocol, in essence, creates a pool for each stablecoin. By depositing a stablecoin to a pool, the user receives their Y tokens that are yield-bearing equivalents of the coin that was deposited. For example, if a user deposits DAI, the protocol issues Y DAI. The DAI that is pulled together can then be moved between different lending protocols to always maximize the yield. For instance, if AAVE offers a better yield on DAI than Compound, the Yearn protocol can decide to move all or some of the DAI to AAVE. The protocol checks if there is a better yield available at the time a user deposits or withdraws money from the pool, triggering a rebalance of the pool if necessary. If a user wants to withdraw their initial DAI plus accrued interest, they can redeem their Y DAI and receive the underlying DAI. One thing that the protocol always assures is to never swap the initially deposited stablecoin to a different stablecoin, even if there is a higher yield available. So for example, if a user deposits DAI, the protocol would never swap it to USDC, even if USDC has a higher yield. This is because most users want to withdraw the same stablecoins as they initially deposited. After the initial version of the protocol was completed, Andre decided to open it up to more people who were also interested in automating their yield strategies. From the protocol's perspective, adding more funds to the pool was beneficial as there were more opportunities for triggering rebalances, with more deposits and withdrawals taking place. After the initial warm welcome by the community, Andre started working on improving the protocol itself. As the money in the pools started growing, some of the previously obvious strategies, like moving coins into the highest paying lending protocol, stopped working. Now, the protocol had to also anticipate what would happen to the APY if a large amount of funds are moved in. So it would have to also optimize splitting funds between different protocols and choose the most optimal solution. At this point, Andre also started working with Curve on the YCRV liquidity pool. YCRV pool contains the following Y tokens: YDAI, YUSDC, YUSDT, and YTUSD, making it easy to swap between the Y tokens without unwrapping them into their underlying tokens. By depositing stablecoins to the YCRV pool, the users can earn trading fees for providing liquidity, on top of getting a return on their yield-bearing Y tokens. Up to this point, finding out what the best APY on a given stablecoin is was fairly easy. This changed dramatically with the introduction of liquidity mining, with Compound's comp token distribution as a prime example. The comp token distribution was also pretty much the time when all the yield farming hype started. If you need a recap on yield farming and liquidity mining, you can check out this video here. Comp farming basically changed the whole landscape of finding the best yield, and checking the APY of a deposit was no longer sufficient. To find out the actual yield, you would have to add up all the extra tokens that were being distributed. Finding the best strategies became more and more complex. With all the yield farming craze going on, Andre, together with the Yearn community, started working on another idea: vaults. Yearn vaults, in essence, are pools of funds with an associated strategy for maximizing returns on the asset in the vault. Vault strategies are more active than just lending out coins. In fact, most vaults.
So what he's talking about now is like this, like, I think what he was describing is pretty interesting, because like that's exactly like it's similar to traditional markets. Like there's literally entire like Wall Street industries around like, you know, arbitraging the difference in that APY and that interest rate across different markets. And so like the whole yield farming thing, like, you know, crypto feels like we invented it, but it literally, this has like been going on forever. Like this is like common markets. And like, and this is like you can see parallels to this from the, you know, from the like, you know, like the traditional markets with, you know, like the arbitrage, like that yield is so low that like they need higher and higher forms of risk to generate more yield. And so that's like where like, you know, some of these like hedge fund strategies, like those are higher risk because like people want to earn on their money, because like interest rates are so low across the board. And so like more and more like speculative money is like, that's what's, you know, aside from like the like endless money printing, just like demand for yield, because you don't make any money lending money anymore. Like interest rates are so low that you can't really earn yield by like lending in that sense anymore. That like the money looks for yield in like higher and higher risk assets. So like stocks and cryptocurrencies. So part of like these like major bull runs in like cryptocurrencies and traditional stock market is just like a demand for yield. And that's kind of like, we see that play out in crypto, because like, you know, literally in a matter of weeks, all the arbitrage opportunities that they're just talking about are now done. And people that are yield farming need to find more sophisticated strategies. And so, yield farming really probably isn't like, it's like you need a lot more money to like make money from it than you might have needed at the start. Because a lot of the arbitrage opportunities are already being sucked out by like automated things like YFI. So that's what YFI runs. And then these vaults are actually pretty interesting because it's like kind of like the next step in yield farming.
Strategies can do multiple things to maximize the returns, such as farming other tokens and selling them for profit, providing liquidity, or borrowing stable coins. Each vault follows a strategy that is voted in by the Yearn community. The full explanation of the vault's mechanism is outside of the scope of this video, but I'll make another one that focuses just on this super interesting topic, so make sure you subscribe to this channel to stay in the loop.
Okay, so we'll go ahead and pause that video. We'll include that link. But yeah, I mean, that's really kind of how this thing has evolved. Literally, just in the past couple of weeks, there's been like this crazy wave. Where in that video they kind of touched on like that like liquidity mining. That's what YAM was. Like that's what this whole thing was about. Let me see how do I view my. Let's see if we can open these MetaMask. Let's see if we can. Okay, never mind. We're not going to look at YAM, but like that whole like concept of like providing liquidity, and I think we even talking about that in the Dipcatcher chat. We're like providing liquidity, it can earn you yield because you're getting paid the trading fees. But if you're providing liquidity on something where price is going up, you're losing money. Like you should just bought and held the coin. So liquidity, like yield farming, like a lot of the other methods of yield farming, I think are like they're probably not going to be as profitable moving forward. And there's like a lot of risk involved too. But that's why Hex is actually kind of like I view it as like a risk-free yield farm, because like if like everybody like who was doing Hex just like stopped, like they just disappeared, Hex could still operate. But if like everyone who's involved in yield farming disappeared, yield farming would come to an end. And so like because Hex just like all the yield isn't based on any external activity. Like in like traditional yield farms, it's like based on either like borrowing and lending activity, or it's based on providing liquidity for people who are actively trading something. But Hex is actually like completely separate from that. And so like, where, you're like going in, like, that at minimum, your like coins are going to earn at minimum, like you can calculate what your minimum yield is going to be. But like, if less people do the activity, you actually get more yield. That's like the interesting thing about Hex is like, if less people are staking to earn yield, the Hex yield farm is like, you're going to earn more because there are less people that are going to be getting that constant 3.69% inflation. So like, yield farming, like, I think that first wave of hysteria around it has kind of come to an end. People kind of got their senses, I think, and a lot of the arbitrage opportunities already squeezed out. So if you felt like you missed anything with yield farming, like, yeah, some people made like crazy, stupid returns on just like wild things. Like YFI, for instance, even though this is like YFI is actually like, you're not earning, like you can earn YFI through like a yield farming way, but like, this isn't really like, what it is like, but because YFI is like linked to this, like, what do we call it? The, Yearn, like because YFI is involved in this like Yearn finance thing, like, it kind of got like up in that, like that hysteria applied to it. So, yield farming, it's like a more advanced topic. So, but still an interesting thing to see go on. And to me, it's really bullish on the Ethereum ecosystem because Ethereum is the on-ramp to these things. Like last time we had a bull cycle, in 2017, Bitcoin was the main on-ramp to other cryptocurrencies. Like back then, people would buy Bitcoin and then send their Bitcoin to Binance, and then use their Bitcoin to buy Ethereum, or they would buy all these other altcoins with it. And so Bitcoin benefited from that on-ramp. Whereas now, with like the whole like DeFi movement, Bitcoin really isn't benefiting from it. I mean, it kind of is, like people taking profit from it, or just like getting people into cryptocurrencies. And like Bitcoin is like, if you come into crypto for the DeFi stuff, you're going to learn about Bitcoin. So Bitcoin benefits in some ways, but overall, you know, like that's maybe why I think in this next bull market, Ethereum is a good one to have. You know, where in the past I hadn't really recommended Ethereum as much as Bitcoin and Hex, but like because Ethereum is so critical, like Ethereum is the on ramp to this like whole like new like wave of DeFi protocols. It's probably a good idea to have some Ethereum. And lucky for us, like, you know, if we look at the Ethereum chart, so let's measure the Ethereum and measured in Bitcoin. So like if we look at this, it's actually pretty. The algorithm doesn't. Okay, the dip catcher algorithm doesn't necessarily work on the Ethereum Bitcoin one as well, because there's like a scaling issue with like the small numbers and like where it draws the thresholds. But like, you know, Ethereum has been outperforming Bitcoin pretty much over 2020. You know, so like what's pretty cool about Hex is that like Ethereum outperformed Bitcoin, Hex outperformed Ethereum, and that's like rare. You know, like Bitcoin's like the measuring stick for these things. So like, you know, even Ethereum's still in like a strong uptrend, no signs of like real reversal. And like a lot of that is because of like the yield farming and just like the whole DeFi experience. So Ethereum is like benefiting from this more so than Bitcoin, you know, and you can see that in the Ethereum Bitcoin trading pair. So we're, you know, whereas, you know, and the last time we saw that, like, where Bitcoin, like Ethereum has really only like been in an uptrend against Bitcoin for, you know, not very long, like from December 20. So pretty much for all of 2017, Ethereum was in an uptrend against Bitcoin, and then all of 2016, and then like the first 3 months of 2016. And then now it's really been in a strong uptrend, you know, for like 4 months. So Ethereum is going to really be continuing to drive the DeFi space. You know, yield farming was just kind of like this first era, kind of how we talk about these like different memes and different narratives that kind of carry forth these cryptocurrencies. You know, yield farming, just add that to the list of new narratives that like kind of powered Ethereum through this time. You know, the last thing that powered Ethereum through was like the ICO, you know, with all these crazy coins. And then before that, it was like World Computer. So ones that are shaped, like that's a great question. Like when you're like looking at these things, like if they just like pop up out of nowhere, like kind of at the peak of hysteria, those are probably opportunistic scams. Like where like they emulate things of successful projects, and they kind of like pop in like at the peak hysteria, like when all the noobs are getting in, like when all the new people are like, oh, look at all these people making all this money for like weeks and weeks, and then finally like they come in. The people that like scoop up from those people, like sometimes those are like ones that are like go from like first time they like whenever the Twitter account opens up to like, you know, the time when you start seeing people promoting it. If that is a very short period of time, it might be a scam. You know, but like on the other hand, like these things, like there's like it takes such little money to push it up, and especially if you're only like, you know, trading with like a pretty small amount, like you're like, you know, your threshold's like pretty low, and so like, you know, it does like it doesn't take a lot of money to push the price up. And like you yourself is like, you know, buying like one Ethereum, like you're not going to like, you know, move the price that much. And so like you can like get in and get out for like a quick trade where you're just trading the momentum, where like you're not like doing any like fundamentals. Like you're not like you're not hoping to buy it for a long period of time. You're hoping to like buy it as part of this like wave of hysteria, like wave of new people. So like even things that end up being like maybe they're not scams, like maybe they're not like they're not promoted. Like I think that like there's different types of scams. So like, and this is like really important to like understand. Like to me, it's only a scam if there's like if like lies or like there's some type of like fraudulent activity going on, like where they're lying to you. Like if there's like some false premise, that's where it's actually a scam. You know, but then like, you know, things that are just like bad investments, those aren't necessarily scams. Like coins that go to zero, like not for like like based on any type of like lie or anything, but coins that just never pick up steam. Like, you know, maybe like, you know, it just doesn't, like maybe the coin needs some type of like business ecosystem to build up around it before it's successful. Those aren't necessarily scams because like, you know, it wasn't maybe done with like malintentions. You know, maybe people were really trying to make it happen, but it just didn't pick up the network effects. And so like things can go to zero without being scams. So like not everything that goes down in price is a scam. You know, but like things that are done with like, where like false intentions. So like, you know, one example would be like BitConnect. So back in 2017, there was a Ponzi scheme called BitConnect that sucked in like millions and millions and millions of dollars. And they did that by telling you that by investing in BitConnect, you're investing in an arbitrage trading bot where you give them their money and then they're going to go and they're going to trade with it. They're going to do arbitrage trading where like on one exchange, they're buying low, and then on another exchange, a couple minutes later, they're like selling that price difference across different exchanges. So kind of similar to some of this yield farming stuff, but what makes yield farming different is that it's fully auditable. Like you can see where all the funds are, and you can read the code on what the smart contract is. Whereas like, you know, that's like actually like moving the funds around, finding the yield. And so you can at least kind of audit where the money is. But with BitConnect, you had no idea what was happening. And they were paying people out profits, not from trading activity. They were paying people from like new deposits coming in. So that's like the big, like BitConnect was a scam because they lied to you and told you that like the ROI on your investment in BitConnect is coming from a trading bot. But in reality, there was no trading bot, just new people coming in. They were the ones that were like their money was going to you. And they were telling you that it was profits from trading, but it was really just profits from marketing. So BitConnect was a scam because like they lied to you, and that's why it like crashed to zero, because when the gig was up, they just stopped making the payments. The people that were behind it just ran off with the money, and everyone was left, you know, stuck because they didn't have the money to start with. So so BitConnect is like like Ponzi schemes. Like it's based on like a false premise, where you know, like they're lying to you, but with you know, so like that's a whole different type of scam versus something that just like doesn't go up in price. Like Simple Token, you know, pumped in price. You know, we can go look at the OST. You know, Simple Token measured in Bitcoin pumped in price and then dumped to zero, but it wasn't a scam. Like it just went to zero because the business use case that would have required Simple Token to succeed just never took off. So there was never any demand for the coin. And because like the way it was distributed just produced constant sell pressure. Like they didn't lie to you by saying like, oh, like you're going to earn some crazy ROI from like this business activity. And then like they were like lying to you about it happening, and then it never was actually happening. Like this was just like a coin that had bad economics. So like, you know, this isn't a scam, but you also don't want to be buying the top. So like, you know, there's a clear difference there, you know, and I think like the one that we saw just this week, let's see if we can find the Ruby Finance. Let's see if that was actually a scam. And, I mean, there kind of is this like new kind of wave of these where like maybe they're not lying to you, but like people are just like pump and dumping a coin to like swipe money from like new people. So let's see if ruby.finance is even a site anymore. Okay, so maybe it was an exit scam. So like that's like another category of these that's different from like BitConnect, where they're like lying to you about some activity that's going on and like paying profit. Yeah, so that's more of like, so in the 2017 ICO days, that was called an exit scam. So if we look at Twitter, like ICO exit scam, we can probably see a whole bunch of tweets. Look at this tweet. Exit scam and ICO, received death threats. Just kidding, I was raising awareness about exit scams. So exit scamming, like, you know, let's see if we can find an example. So like, you know, this is where like people come out with these like vast promises of like some crazy coin they're going to build. They raise an ICO with just like a vanilla, like they go to something like token launcher. Let's see if we can see. They'll go on something like, where's the token? I don't know if this is even one, but like you can go on a website, launch a crypto ICO, and then you've got a what's it called? You know, you've got a coin you can raise money on, and they raise like tens of millions of dollars and then run away with the money and never do what they said they were going to do. So like, you know, that's like an old, like that was the old ICO exit scam. You can like, you know, see tweets going back to like, let's see how far back, you know, like ancient, you know, ICOs, like that was the game. That was like the scammer game. And a lot of those popped up after like, you know, like there was like years of successful, like legitimate ICOs. And then when people saw when scammers saw how much money these people made on legitimate ICOs, they made fake ICOs and then exit scammed with the money. So that's pretty much, they just like dump all their coins on people, or like they're just selling throughout, and then they just like run away with all the ETH. So that's like a potential exit scam. And so like, you know, that's like a type of thing where like it may not be based on false premises, but like a major token holder could just dump the price, you know, but that's the risk of any coin where like somebody owns a lot of it. So like sometimes like, you know, if the creators of it, you know, they could just dump the price to zero and just be done with it. And so that's, you know, that is part of the risk of hex, you know, because like, you know, there's, you know, like, you know, the OA address, you know, that's a fact that they have a lot of the supply, and they could dump it, you know, but like all the coin, like, you know, all the coins that are involved with OA, like none of them have been sold. They've all been like, but not all, some of them have been staked. Some are just sitting there unstaked, you know, but like the difference between, like the reason why I think that's like, there's less of a risk of just like a sudden dump of like the hex OA, even though like hex, the creators, you know, or whomever it is that controls the OA, they have a lot of hex. There was years and years of time put into hex and investment put into hex before hex launched, and hex didn't launch like at like peak hysteria, like Ruby Finance. So like Ruby Finance, that launched let's see if we can find Ruby Finance. Like this launched like peak hysteria of like all these like yield farming things, and you know, just like kind of came and went, like all of a sudden like appeared. Whereas hex actually started as a completely different cryptocurrency idea that Richard Hart was talking about. I first heard him talking about it in 2017. So like hex had like years and years of like development and like community formation. So like to me, that's like proof that it's like less and less likely to be like a quick money grab exit scam. Because if it was a quick money grab exit scam, there wouldn't have been that much time and effort put into it at the start. You know what I mean? Like, so, or, you know, like it just, to me, it makes it less likely to be that, because there was so much like, to me, there's proof in the pudding. If someone in public is putting forth time and effort around like building something, and then they actually deliver on it, to me, like, you know, seeing Richard Hart, like, talk about just like literally, it's all in the public. You go back to Richard Hart's YouTube channel, you can look back at all the old videos and watch like the whole development, where it used to be the CFD coin, where Richard Hart was talking about Richard Hart CFD coin. like way, let's see, way back, back in his old, look at these old videos. He was probably like in some of these videos, he was talking about how he was building the computational fluid dynamics. Yeah, so that way back when Richard Hart was working with this guy.
Hello, everyone.
To like try to build a cryptocurrency that you would mine by having your computers run this computational fluid dynamics modeling software. Like there's some wacky idea. He was trying to, build this thing, but then he turned out being too hard. And so then he pivoted the idea to be the time lock, like the staking coin. But like, I was watching, Richard Hart with these videos back as early as 2018. I think this came out in 2017. But like, so I had seen this development. So like, that's why I'm not like as worried about like concentration of supply in Hex, because I've been following what this creator of Hex has been doing in public for, almost 3 years now. So to me, there's like enough, like kind of, like that, that is the risk though. But like, to me, like what counteracts that risk is that I have some elite, it's not like someone just like fly by night came in and said, ooh, come buy this thing. Like I was listening to Richard Hart talking about this thing for 2 years before I bought it. And so like, as far as I'm concerned, from the first time, like, from when I first, like we brought up Ruby in our DiffCatcher channel because Ruby was promising this like staking where you could like earn interest by staking. So I was like, I posted it by saying, a lot of these new coins are like emulating things that Hex did. Like they're using Hex's marketing message because it was successful, because Hex was a successful cryptocurrency, and so like, other coins were like trying to use it. So that's how I brought up Ruby. And then if we try to, I don't know if we can even find the Ruby price anywhere. Maybe on ChartX. Let's see if we can find the Ruby price. This was what in the DeFi space recently has been called a rug pull. This is where somebody has a lot of liquidity in the liquidity pool. So like if we go to the, yes, this looks like, so if we go to the Uniswap, so pools, let's see if we can find pools.fy. Let's see if there's even a liquidity pool for Ruby anymore. Daniel, when you were looking at your Ruby, were you even able to sell it? So that's like this, like the new word for ICO exit scam in the DeFi space is rug pull. And that's like this new type of scam where like, like these people like come and pump up the, so Ruby, like I wish I had screenshots of the old Ruby site. It was literally like a clone. It looked like it came from somewhere, but like these cryptocurrencies are like they're just like, so people will launch these new ones and then it takes such little money to push the price up that they'll just like they'll be the ones providing liquidity and pushing the price up. And then what they'll do is they'll dump all, so like they'll slowly start withdrawing liquidity. And then they'll just like pull all their ETH that they put in the liquidity pool and then dump all their Ruby before all the other, so they'll build up a lot of people providing liquidity other than themselves. And then in an instant, they'll withdraw their liquidity and then dump the price on everyone else who's providing liquidity. So they're effectively trying to suck in people to provide liquidity in exchange for transaction fees and sometimes bonuses for providing liquidity. And then they'll just like dump on their heads. And so people are calling that rug pull. So like, let's see if we can find people talking about the Ruby rug pull. Wow, no one's talking about, maybe we might be the first ones. Yeah, so Ruby, because that literally, that maybe we need to be the first tweets about, yeah, we might have been the first ones talking about my first scam Ruby, be careful. Got burned on Ruby. Let's see. Pump and dumps. let's see, I think there's this one called Hot Dog. Yep. Latest DeFi frenzy, Hot Dog. Didn't last a day. Crash in the, so this might, I don't know if like, I don't know, there's 4,000 to $1 in 5 minutes. Like there's all so like right when there's a lot of hype and hysteria, that's when people like come in and try to take advantage of all the hype. So if something's been around for so short, like, only risk money that you might risk on like going to it's okay to do that. Cause like on the other hand, like, flow, like, which we had done that whole video about. And I like, let's see what the flow price is, which, I don't know I don't think flow was a like a scam necessarily, but like this price is just bled, like, I don't know. We'll have to check the flow Telegram chat to see if what people are talking about, but like, this one just, maybe it's just a coin that just hasn't really taken off. That on the first day, buying that the first day, you're still up 100%, like, so like the first couple days you're still up. So in this case, maybe it wasn't a scam, but maybe the creator of flow is baiting people into the scam. And I think even you, Daniel, you even mentioned that Ruby claimed that they locked up a bunch of funds. Yeah, like literally. the announce the announcement of the announcement. I know, dude. Oh my god! All right. What's funny is because, like, kind of I was telling you that I just closed out. Like, I bought some Ruby, and then I just closed it out because I was just like, I could kind of sense that some of the DeFi stuff was like there was too much craziness. Like, I was like, all right, like, which ones do I think are like least, like, which ones did I come across on a whim, and which ones like, like, do I not really like? Do I think there might be another big buy opportunity if there's like, like ones I'm like, okay, first day ones that like I don't need to be on the first wave up, like too much risk, and I just wanted to just like close out because I needed to pay. Like I didn't want to focus on this stuff for a while. So like, one, I thought kind of DeFi hysteria was kind of coming to an end, or at least slowing down a little bit, and then two, I just need to focus on other things. So I just I closed out on my Ruby, luckily, just like unrelated. Because I bought into the same thing you did. Like I was like, oh, they locked up liquidity, and that's what Flow did. Like Flow actually, they claim that they proved. So if we go to Flow protocol, yeah, they're all different, and because some people, like, 'cause everyone's looking for that first day pump, like everyone's looking to buy in, like when hex is low, like everyone's looking, and so like people get kind of caught up in that, and so like scammers take advantage of that, and so like I was trying to look in here because like they claimed that they had locked, like the creator of Flow, like that's part of what led to this massive run up was the creator claimed to have locked a bunch of funds. And whether I didn't even know if that's true or not, but that helped push the price up. So like maybe Ruby.finance was like, okay, Flow pumped because they said that they locked a bunch of coins. So we're gonna say that. And so the scammers who pulled the rug on Flow, like, they might have tried to do that same, thing. Like, so what did Ruby go down? Let's so say you just bought like right in the middle of that. Oh my god, 98%. That's so funny, and that's the thing, like kind of what we talked about, with these like early ones. It's like for these like very high risk ones, like don't put more money than like you can afford to lose. Like that's like such like no brainer common sense advice, but still like you want to, put money that you might spend on Netflix in first day coins that could end up being rug pull scams. Like, because like who knows, like say, we look at the Ruby chart, if you would have bought here. That's 100% true. Because like it's really hard to learn this stuff unless you're actually like in the game. Like something like sometimes like I don't know how much people like for people that are like regularly on our calls and like actively doing it. I think it's a lot easier for them to pick up on some of the stuff. But like if like it's hard to really it's hard to understand these things unless you're actively in the game, and like taking risks on these things like it's just practice. And then it gives you the chance where like, if you bought, even if you bought into something that's a scam, and here's like the whole other end of it, there's money to be made on scams. Like if someone else is perpetuating the scam, like they're trying to push the price up, and it may be like, they may be artificially pushing the price up too, like with their own money. And so like, in some ways, like one way to fight scams is to buy them when they're low, and then sell them when they're high. Because what you're doing is if you're selling like say you bought Ruby like a couple hours after it launched, you bought in like right here like and then price goes up 72%. If you're selling there, what you're doing is you're preventing price from going higher. And so what that means is that like for somebody who's going to get bought into the scam, like we're like the people behind Ruby are like, oh, we just locked up all our coins. Like this thing is going to $100. Buy in, like, provide liquidity to our pool. You'll get bonuses, 1,000% yield. Like literally, like I saw that on some charts, like literally craziness. Like they're trying to suck new people in to be buying right there. Cause like they're buying from the scammers. Like, you can help save people who are getting scammed by helping push the price down by selling the top of scams. So like, quick flipping something that you might have a feeling is a scam, you're actually helping people who are getting scammed by not pushing the price higher. Like you're helping cut their losses from being like, 98.79% to maybe you're helping cut their loss to like 98.5%, and like, and what you're doing is you're taking money that the scammers might have otherwise taken, so like the scammers, like those are evil people. They're lying and like ripping people off to take their money in a dishonest way. Like that's evil. That like, and the only way to counteract that evil is to take that money that the evil like scammers would take. Like, so this is one way to do it, like momentum, like swing trading a scam, because you're taking money, like, you're taking money that the scammer would otherwise have taken. You're taking that profit. So like that's one way to fight back against scams is to out trade them even in their own scam, and like and that's kind of what like with these ones, even though they're like there's scamminess going on, like you can do a quick 100% trade easy. Like I mean, not easy. You have to have the skills and be equipped to take action on the skills to make that trade. But once you gain the skills and the confidence to do that, then like, you can help fight scam. It's funny, in crypto, you can help fight scams by buying and selling scams, and because there's opportunity literally like throughout this whole period of time, there are opportunities to buy and sell at like 100% gain, and so, like for things where like you're like never go all in on something on the first day because it could go to zero. But if you like, go in with like Netflix money or like, some type of like concert money or, the sum of all like, maybe all the money you would have spent at bars, like you can spend that on these on the first day, and maybe you can make a quick 100% gain, and you'll be pretty happy about that. And if it goes to zero, who cares? Like, keep trying. Like, keep taking risks. Keep seizing opportunity. So things like Ruby. Like, I apologize for bringing Ruby into your world. But like, if you only put in a couple bucks. Yeah, that's really cool. Yeah, it's like, you don't. And that's how I felt like, with what we talked about a couple weeks ago with Simple Token, like the only reason I know everything I know now about crypto is because I had that experience with Simple Token where, like, I left so much money on the table, by thinking Simple Token was going to run up in price during that whole period of time where I was getting paid in it. Like, I was like, just that, like, having lost that money, even though I didn't really lose it because it was all like, it wasn't really money I'd put in. Like, just leaving money on the table though, like, just having that experience, like, that tuned me into things that, like, if I would have just like heard about by like watching like someone on YouTube talk about it, like, I wouldn't really know it like how I do because I actually sat through that. You have to take the L's. Like, you have to, there's no W's without L's. And so, that's and like you said, like, getting that practice, because it's just more, it's just more reps. You knew how to make a trade on Uniswap. You knew how to like look at the chart. And so, like, every time you look at the chart, every time you make a trade, it's like you're just getting more and more practice. So, like, so definitely, and it fits, it fits into like what we were talking about like earlier when we were talking about flow. Like, that's the risk on first day coins. It has the risk. Literally, it's exactly what we're saying. It has the risk of going to zero. That's why it has that's why it has the potential to go 100x, because there is the risk it could go to zero. And here it played out perfectly. Where, like, this thing went to zero. You can't even sell it. Now it's a collectible, dude. You've got these, and that's the thing, because like the ERC20 token, like, let's see if we can find the, let's try to find the coin, because like that's a thing. Like, your Ruby may turn into some like digital collectible, like kind of looking back on like old scams, because it has a cool name, like Doge. Doge wasn't a scam; it was just like a joke, But let's see. Let's look at the holder. Let's look at the bag holder. So, oh my god, this is so funny. Okay, well, at least you're not this wrecked. That's probably okay. So at least that's not you. At least that's not you. I guess, there's really not that many people that had a lot, because what was the price of Ruby? It got up to like $1 or something. So as far as Ruby holders go, yeah, it was a relatively new thing. So where is that? Etherscan. Am I blind? So like, this person had 7,000. Oh no, those are transactions. Those are holders. Those aren't. Oh, okay, that's the creator. So the creator actually still has a whole lot of Ruby. Maybe they pulled liquidity pool. They've still got a lot. So they still have more than half. But at least you're not like this guy. This person had $8,000, and now you have probably $85. Like, at least that's not you. Luckily there aren't people that have too much that they lost, and maybe they like sold to help push the price way down. But there's all these people that are doing way worse than you did. So like, do not be these people, unless these people had hundreds of thousands of dollars to lose. Then in that case, that's nothing to them. But like, you don't want to be. There's a Telegram chat. It's called Wrecked Plebs. Let's find. I love reading these. Look at this. It's just like someone compiles all these messages from all these channels. Lost everything in YKFZ. Need help. Got scammed. Bought a coin I can't sell. This one. Stay away. 81% dump. What is this, admin? You tell hold. Like, these people probably lost more than they can afford. And so, like, you know, if you're going to buy things on a whim on first day, like, by all means do it. Like, you know, you can make money doing it, and you can fight scams that way in a weird way. But, you know, do not lose money. Like, I stress that, you know, it goes without saying. Like, you know, if you're going to risk money that you're like not okay with losing, put it in Bitcoin, because that's like the least likely to go to zero. Like, that's why, like, you know, there's like Bitcoin's not having like 100x overnight things, because, like, you know, it doesn't have the risk of going to zero. So, like, that massive quick gain, like, it's not there. There's not get rich quick on it anymore. So, like, if you're going to put money that you can't afford to lose, put it into Bitcoin. But if you're going to put money, but like, you know, for money that you can't afford to lose, like money that you just otherwise just like squander on like television streaming, like, by all means, put it into first day shit coins that might be scams. You know, hopefully don't go into it because you were scammed. Like, don't buy into the lies. Like, don't believe whatever they say. Like, trade the chart, like, trade the momentum. And like, so trade the chart and trade the like, you know, like, literally, like all the people like you, Daniel, they got kind of sucked into the Ruby Telegram chat. Like, trade that momentum. You know, don't buy when everyone else has already joined. Like, don't, if you can sense like you're the last one coming in, don't do it. But like, if you see something where like there's not a lot of activity, first day thing, you know, maybe they're starting to tell lies like, oh, we're going to lock liquidity. If you can buy before the hype and then sell into the hype, like, you know, make that trade, you know, even if like you might sense it's a scam, but like, don't be bought into it because of the lies. You know, and that's why, you know, like with Hex, like, you know, people are worried about, you know, the like just the OA having so much Hex, but like you're never told what's going to happen to that. So like, by default, you should just treat the OA like any other holder, where like, you know, everyone who holds any coin could sell at any time. And so you can factor that into your risk profile, you know, but like, you know, but like, there's not like promises of things that are going to be going on with the OA. Like, the people that control the OA, they don't promise you that they're going to be doing work. They actually, like Richard Hart, like every time you hear him on anything, he's like, I am not going to do any work for you. I'm not going to pay you to do any work for me. Like this, like, there's no work being done here. Like, you know, if you want work done, do it yourself. You want ads, pay for them yourself. You want people to learn about it, tweet about it for yourself. Like, you want to build stuff, build it. Like, you know, there's not promises of work being done that's going to deliver you profit. All the profit that you're promised in Hex is it's done through the smart contract, and it happens whether anybody's doing any activity or not. And so, like, to me, like, you know, there's like that's why, like, you know, I truly believe, and that's why, you know, I'm fine with recommending to people that I care about to look at Hex and make Hex part of your saving strategies, because like, I don't think, you know, it has risk of going to zero because it's so new, but it doesn't have like it doesn't fit in the category of things that are going to be like exit scams that like send it to zero. And so that's why I'm more comfortable, you know, recommending it as part of our like suite of like, you know, our like bedrocks of crypto, you know, like the Bitcoin, the Ethereum, and the Hex, is because like the value proposition of Hex is the yield that it earns you. And the yield happens regardless of, without the work of others. Like, it happens based on the rules of the smart contract. And you can execute it without, even if go.hex.win went offline, you can execute that without anything happening. So like, there's no like false premises about what the value proposition is. Like in Ruby, I forget, what was Ruby's like value prop? What did they say they're going to do? Oh my God, I wish I. Um, oh my God, yeah. Few promises of future work. Like that's something that's something I really align with like the Hex community on. Is it like there's no promises of future work. There's the opposite. There's promises that no work is going to be done. And so like that's as it feels like Ruby, like they're like, oh, we're gonna do all this stuff. Oh my God, dude! If I would have read this, I shouldn't blindly share sites like that because to me, what I read was the staking part. I did if I would have known that it was meant to be like a peer-to-peer transaction. Like we always talk about that. Like things that are optimized to be like for transactions, those don't pump in price. Yeah. I'm sorry. I'll have to buy you a movie. I'll have to buy you a movie ticket for having lost your movie ticket. But yeah, and that's and that's what's exciting. These things play out in real time, and that's the only way to learn. So, that's I'm glad we kind of see that without risking too much. Um, okay. Yeah. I was just about to wrap up too. I think we hit on all the topics that we were going to talk about today. We went a little longer than we were going to, but this such important topics to to talk about. With how to how to understand the Bitcoin dips. What this whole like yield farming thing is, and then how to spot things that might be pumping up scams and so thanks for everyone who sat with us on the Zoom call and for everyone watching live on YouTube. This was awesome. Thank you so much, Daniel. This was great. And until next time, we'll be back right here. Dipcatcher Radio signing off.